joined Kaizen in 1st of June, predominantly to do risk management for them and to do derivatives trading, options and futures, as well as to build a fixed income strategy into the portfolio. The reason for us looking to the fixed income market to build a strategy into the portfolio is we feel that with all the quantitative easing and monetary policy stimulus that has happened globally, and all the capital flows that have come into the South African fixed income market, we feel that our yield curve is mispricing the fundamentals. And this, we feel, has created a lot of opportunities for us. If you also think about the fact that South Africa, because of all the funds that have come in, with South Africa joining the global bond index now in the beginning of August, and the capital flows that have come in, year to date it's over about 60 billion in cash that has come in. This has resulted in South Africa becoming a monetary policy acceptor rather than a dictator, just because of the fact that liquidity is so flush globally. And hence we're starting to see some great opportunities emerge in that space. We would also like to look at corporate bonds, South African companies who've issued debt offshore. This would be an extension of our current core competency, seeing that we already know the local companies, the big banks. Here I'm talking from like Old Mutual, the insurance companies, Standard Bank, Investec, etc., and then to see if we can maybe build that into the portfolio as well, because the yields, these bonds are still yielding in excess of 6 to 8% currently. The yields have been compressed quite substantially because investors have allocated quite a substantial amount of money to corporate bonds. And we feel that these companies, they've got strong balance sheets, it's good management, they've got competitive positioning, so we feel comfortable holding on to their debt, seeing that we are already holding the equity. And so that's basically why we would focus on and build that kind of strategy into the portfolio. If you compare our local bonds, we're getting a yield of about 6 to 7%. And if you compare that to international bonds, international fixed income instruments like the US Treasuries, you're getting roughly 1.5% there. So, I mean, for an international investor, it just makes sense to allocate money to the South African, or to pick up the yield. It's more a yield play, because in a low yield world, I mean, investors are looking to generate returns. And the only way to do this is for them to allocate money to, like, for example, the South African market or other emerging market fixed income instruments, because it's accretive for their portfolios. And hence the money that has flown into the South African bond market, purely from a hunting yield point of view. And because all of this money has come into our market, it has pressed down our yields. It was trading at about I think it was probably about 9% or so, like on our longer term debt towards the beginning or end of last year, and it's currently trading, I mean, even after the rate cuts, it's come down to about 6.5, 7. So I mean, hence the money that's come into our fixed income market. The fact that our political risk has totally been discounted already. The fact that we have everything that's going on, the nationalization rhetoric and all of that kind of stuff, our yield curve's actually not pricing that anymore. Why is not everybody allocating money to our bond market? Well, they've added us to the global bond index. I mean, they want a piece of the action. I mean, they've added us to, I mean, we're part of the index now. So hence that has already resulted in a lot of capital flowing into our fixed income market, so that it could obviously drag up the yields. Yes, it is weighted. It will obviously be accretive for the rest of the guys. Why is not everybody allocating money to our emerging market? There's always still the risk. There's always the we've got higher inflation here. We've got the currency. They obviously will be playing the currency. If our currency depreciates, which it has since, for example, beginning of the year, late last year, our currency was trading at roughly 7.5 rands to a dollar. Today it's trading at about 8 rand 20 or 8 rand 15 to a dollar. So I mean, if these guys needed to repatriate their gains, they would be making a loss because of the currency moves. So there's still a risk of that. I mean, if the currency moves by 15-20%, you've essentially wiped out all your gain. You're making 8% on the bond. The currency moves 10-15%, you've made nothing on the trade. So I mean, hence the fact that they haven't. The guys have also, international investors have been thinking that the rand is too strong, which we as South Africans all know and we've all been thinking for a long time. Hence the fact that not everybody has just been allocating money to the fixed income market.